All right, we're doing the numbers for market update for May of 2022. Let's start with the U.S. stocks. Value rotation is continuing, and that was something that we're happy to see since September, plus our reallocations here, and the big sell-off of growth stocks and tech specifically. But yeah, we're up 3, 3, and 4 on the value side between large cap, mid cap, and smalls. On the growth side, down 6, 3, and 4. So actually, this makes sense. On the upside, you would expect the small caps to actually outperform the large caps because they're growing. But on the growth side, it's flipped. It's upside down. We would expect a bigger sell-off in small caps. So this is the world of stagflation. This is the world of bubbles popping. And yeah, kind of should have seen this coming, I guess. But international's up 89 basis points, half gains on emerging markets. It's currency driven, which I'm not going to dive into currency, but anyway, short-term, intermediate, and high yield, we're seeing some gains in bond prices, which is interesting, pun intended, but selling off in long terms and tips, that's frustrating. We're seeing some changes in the spreads in the yield curve. That's why you get some negatives and some pluses in the midst of interest rate hikes, which is what's going to continue going forward. Real estate sell-off of 4.5% in a month is a lot, but I think we got a little further to go. I've been kind of looking at this real estate as overbought for a while, and it's a very slow sell-off, but this one's kind of ramping up. 4.5 is definitely not good. On the flip side of that, 11.2% gains in oil. You all know it, you feel it. This is a consequence of a bad decision, right? These types of inflationary events don't just happen by accident. They are completely driven by policies, things that we have decided to do. This is the consequence. So maybe we'll learn it this time, but that's kind of the thing about history. Gold down 3.6. It doesn't make sense. I mean, as we're devaluing the dollar, watch precious metals. We called it oil. We knew it was going to be factors of production, but now there's going to be a call for a store of value. Plus there's more currency stuff in there. But let's look at the indexes. For the month of May, NASDAQ's down 2%. That's the growth and the tech sector. So you can kind of see it over here in the equity box. But S&P is up 18 basis points. A moderate portfolio is up 28 basis points because it's being helped out by its bond positions. If you recall last month, as interest rates were kind of taking off the floor, we saw the flip side where everything was crashing, and so moderates were not doing much better than full-on risk. Here they're preserving about 2%, which is nice. Matthews Wealth Management here, we're 19 basis points up in May. Down 23 NASDAQ, down 12 S&P, moderate saved you about 2, and we've saved you almost another 2. So definitely happy with how this number is looking. It's frustrating that everybody's losing money, but it's about preservation on the downside. Each one of these percentage points is just as good, if not better, than an extra one on the upside. So one day people will figure that out, but it's math. Math is hard anyway. So when we come back in June, we'll have another 50 basis point hike to see how that's going to shake through the growth world. Even the value might falter a little bit. International, a lot's going on. We probably won't see any positives there. We'll continue to see negatives. Real estate with higher interest rates, I mean, it's not looking good there. And it's a supply issue with oil. It's not about demand. Stimulus checks, I know they're going to push for it towards midterms, but it's a supply issue. Duh, let's fix that. And just pay attention to gold, silver, precious metals. We'll be back here and see you in June.